Wealthies, welcome back. If you're new here, this is All the Wealth, our wealth building channel. And today we are bringing back Matthew, our portfolio strategist, to talk about tariffs and all the uncertainty in the market.
Hi, everyone. I'm Matthew Levy, a financial analyst, designation holder, and portfolio consultant. Today, I just want to talk about something you probably heard about in the news a lot lately, the new tariffs announced by the Trump administration, and want to talk about how they're impacting the stock market a little bit. Don't worry, I'm going to try and break it down into everyday language so we can try and make sense of it together. Just as a side note, it's March 9th, and these things are changing very quickly, but we're going to try to do what we can. First off, let's just quickly talk about what tariffs are. They're basically taxes imposed on imported goods. Say you buy a t-shirt from Canada, on its way to Canada, it gets stopped and you have to pay an extra 10% of the value of that t-shirt to the government before it can be delivered to you. The idea behind these tariffs is that they're usually to protect domestic industries. So rather you buy a t-shirt from America than from Canada. But as we've seen before, they can lead to some pretty unpredictable outcomes in the economy and especially in markets. Now, tariffs and trade wars are a bit tricky because they basically inject uncertainty into the market. And I mean, it's telling that the chair of the Federal Reserve, Jerome Powell, has said he needs to wait for more clarity before making any moves. That should tell you everything you need to know is that there's still a lot to come. One key thing is that stock markets absolutely do not like uncertainty, and tariffs create plenty of that. Think of the markets kind of like if you're driving through a dense fog, maybe it's the winter, visibility is a little bit low, you're probably going to slow your car down and maybe drive a little more cautiously. In the markets, that means caution means volatility, or in simpler terms, stocks are going to bounce around a lot more than usual. One thing we can do is take a look at a recent example, semi-recent anyways, and get a sense of how long this might happen for, because we've been in this situation before. History repeats itself. Let's take a little rewind back to 2018. So 2018 was the last major trade war when the first Trump administration imposed significant tariffs primarily against China. Initially, the markets reacted pretty negatively. At one point, the S&P 500 was actually down just about 20% from its high point. The interesting thing is by the end of 2018, markets actually recovered pretty significantly. They were only down about 6% for the year in 2018. Still a loss, sure, but pretty strong recovery from the worst of the panic. Fast forward to now, we've seen markets already pull back about 6% since the new tariffs were introduced. It might actually feel worse than 6%, if you're seeing the headlines and reading the news. But this type of drop actually isn't really historically extreme by any sense. Pretty typical for tariff-related issues. But the catch is that right now uncertainty is still quite high. And the longer this trade war drags on, the more volatility we might see. What we tend to say in the industry is that many traders like to sell first, analyze later. If negotiations drag on and escalate further, we could certainly see bigger drops in the market and more volatility could be around the corner, but quite normal for investing in a risk-based asset. We're getting pretty complacent over the last couple of years with the markets up 20+% in back-to-back years. A pullback like this is just quite normal. And I want to emphasize that despite these pullbacks, getting out of the market at this point in time is probably one of the worst things you can do. We saw it back in 2018. The markets did recover significantly. And then in 2019, the markets were up just under 30%. What I can tell you is that when the markets were down 20% in 2018, the headlines in the news weren't telling you, hey, buy now, it's a great opportunity. It's quite the opposite. It's a lot like what you see in the doom and gloom news today. So the problem when selling when things look bad is number one, when do you get back in? And number two, you might miss out on a significant rally while you're trying to figure out when to buy, as the market drops fast, but it recovers just as quickly, if not quicker. Risk is part of investing. That's why those who stick with their plan tend to get better returns over the long run. Just as a side note, since World War II, the S&P 500 has declined by 10% or more, so a correction defined as a 10% drop from the high. 24 different times. The next part I'm about to tell you is actually more important than that drop. The bull markets that followed those corrections are generally much stronger and last much longer. The 24 corrections took about 5 months before seeing the bottom. The recovery back to the same level, that same peak, took only about 4 months on average. And again, as a side note, you see one of these stock market corrections about every year, 1.2 years, every 1.2 years since about 1980. Pretty common, pretty normal, just part of investing. What you need to do is really stick to your plan. Now that we've kind of covered that, I want to take a look at how these tariffs kind of impact certain sectors. I want to start with industrials and manufacturing. Companies in these industries rely pretty heavily on imported raw materials. So like that t-shirt example, that you need lots of goods from different countries to build your end product. And when there's tariffs on things like steel or aluminum or some of these inputs that raise the cost of these materials, it squeezes their profit margins. So think of like if you're going to your favorite pizza place and suddenly that pizza place had to pay 20% more for cheese. They've got a couple of options. One is to increase their price, inflation. If they increase it too much, it might drive away customers. Maybe you won't go as often. Or they keep the price the same and they accept the lower profits. In the public market, if you accept lower profits, your stock price tends to react negatively, especially over the long run. Either way, it's a challenge, and it's gonna affect your bottom line. And next, I want to talk about tech companies. We talked about tech companies as a part of the S&P 500 in a prior podcast, just about how it's a huge sector in the U.S. economy right now. The tech sector has a really complex global supply chain. That means they source components from all over the world. So when tariffs disrupt these supply chains by adding an extra cost that maybe they hadn't planned on, these tech companies, delays can ripple through pretty quickly. It's like being at an airport or being on a plane with multiple connections. If your first flight is delayed, it might seem like a small issue, but suddenly that'll lead to multiple misconnections, canceled flights, and hundreds or more of unhappy travelers just stuck in the waiting room. Tech supply chains work pretty similarly. So a small disruption at one point can lead to serious delays, cost increases, and in general, unhappy investors. And then the consumer goods and retail companies, tariffs mean higher import costs. It's kind of the end of the day and those import costs often get passed on to consumers through increased prices, like the pizza. If you want to buy a new TV and then suddenly that TV becomes 10 to 20% more expensive, you might not end up buying it. Some people will still want to have that new TV and purchase it, but at the margin, as prices rise, consumers start to tighten their belts and spend less. That becomes an issue for the U.S. economy, which is a consumer-driven economy. So consumers spend less overall. It has an outsized effect on the economy. Moving on from the sector issues, in the past few years, one of the biggest concerns has been inflation. Higher cost of goods, higher cost of living, higher tariffs generally mean higher prices for those imported goods, and those price increases spread throughout the economy. The issue is that when inflation picks up, central bankers like the Federal Reserve typically respond by raising rates to cool things down. Higher interest rates make borrowing more expensive, so your mortgage, your car loan, etc. And a prolonged trade war could slow economic growth by forcing the Federal Reserve's hand to try and fight inflation. There's a balancing act. The central bank isn't full of non-smart people. There could be a reason for them to actually lower interest rates if they see the economic impact being too large to the downside. But if you've been reading financial news lately, and not everyone does, I get that, but we're starting to see a word creep up, and it's a tricky scenario for central bankers. It's called stagflation. This happens when the economy is slowing, but inflation's rising. It's one of the toughest situations for central banks because their usual tools, like cutting interest rates to boost growth, they're just not as effective when prices are rising. It kind of eats into that extra growth they're trying to generate. So again, what does this mean for you as an investor? The first thing you can do is just stay diversified. It sounds like some boring piece of financial advice, but it genuinely helps you manage the risks that we can't control, like these trade wars or market downturns. Spreading your investments across different sectors, different asset classes, it makes your portfolio more efficient and better equipped to handle market shocks. At WealthMore, we've got a conservative portfolio balanced, moderate, and aggressive growth. And they're specifically designed with diversification front of mind. And second, and this is really important, is to keep a long-term perspective. If you've been investing in the markets for a long time, it's tempting to panic or make impulsive decisions when the markets are down. But, remember, markets have historically rebounded from downturns and continued their upward trend over time. The 18 scenario demonstrated this really well. Those who held through the turmoil saw a strong recovery. 2019 was an incredible year for stocks. 2020, despite the pandemic, ended up strongly higher. 2021 as well. 2022 was a negative year with the war in Ukraine and more COVID-related issues. But then the last 2 years were both 20+% gains. What I'm saying is the stock market will have corrections from time to time, but overall, as long as you stay invested, you're going to be okay. Another saying we have in the stock market is that markets can remain irrational far longer than you can remain solvent. So what this means is don't try and predict what it's going to try and do. Build a strong portfolio, stick to your strategy for the long term, and you'll do well. Last thing you can do is stay informed, or at least have your financial advisor make sure they're staying informed. At WealthMore, always keeping an eye on policy changes, economic indicators, overall market sentiment. It helps us and you make informed decisions during uncertain times like we're in today. And just to sum things up quickly, yes, tariffs are introducing more uncertainty and market volatility, but the current pullback of 6% is fairly normal for a trade-related event, but the continued uncertainty means, we need to stay alert. We need to make sure the portfolios are designed properly, and your best defense, diversification, keeping a long-term outlook and staying informed. Anyways, I hope this helps clarify what's going on in the markets right now. Thanks so much for watching. And if you have any questions, don't hesitate to reach out.